Good morning, everyone. I'm Evan Lazarus with T3 Live.
And I'm John Darsie, Editor-in-Chief of T3 Live, and together we bring you the Morning Call. So, Laz, we had a quiet day in the market yesterday after the biggest weekly gain since December 2011. The S&P closed at its highest level since 2007. Yesterday was very quiet. We have earnings season kicking off after the close today with Alcoa. What do you expect today? Do you expect another quiet session, or do you think volatility can pick back up here?
Well, I expect more quiet, and I'm going to tell you why. I think, as an educator, we always know that in the markets work in cycles, and there's an expansion cycle, and then there's a contraction cycle. And generally, after you see a very large gain or a large decline in a very short amount of time, which is what we've seen, you can expect some contraction to follow. It's the markets tightening up. It's the markets, kind of feeling out the levels, building bases. If we are going to launch higher, if this market's going to trade higher, it has to contract after that large overnight gain. We saw a very, very large gain from the last day of the new year into the first day of the new year. And now over the last couple of sessions, you've seen some very, very quiet, ranges are starting to tighten up. And that's what the market's doing here now. So it really is a waiting game.
Yeah, futures are about flat this morning. Yesterday we had the lowest volume day in the S&P since the day before Thanksgiving, which is a little bit surprising. As you get into January, you expect volume to pick up a little bit, but we'll see if volume can pick up a little bit today after yesterday's very paltry volume session. We're going to start again with the banks, same thing we did yesterday, because frankly, that's the sector that's worth paying attention to right now. The banks are leading this market higher in the absence of leadership from Apple and some other tech names that have typically led the market higher. So let's go ahead and take a look at the charts of the banks.
Lots of rotation here, and the banks have been basing for a while, and into November and into December of late last year, we saw some expansion in that arena. And we're going to start here. We're going to look at Goldman. Goldman's been a sort of a benchmark here, and you can see for the last 6 months, June, July, into the tail end of 2012, Goldman had a real large run. We saw break out of this base from 90, consolidate for 3 or 4 months here into the tail end of 2012. And then right towards the latter part of December, we broke out again. We gave that nice, 10-day consolidation here. I know Scott had talked about this, and kept an eye on this one. And then, into early January, boom, there we are, new highs with the market. And even yesterday, a very healthy contraction in price. We saw that expansion and then followed by this little contraction. So it still looks very healthy and still looks like we can see higher prices in Goldman.
Yeah, and it's also important to consider the fact that yesterday we got a settlement with the Department of Justice with the banks for mortgage improprieties. And the fact the market and the banks have been able to absorb that type of bad news is a very positive sign for the banks, and a sign that perhaps after some more digestion we can get another leg higher, despite the fact that a stock like Bank of America is up over 20% in the last few months since the $10 buy price that we listed on Off the Charts and the price point sheet.
Well, let's take a look at Bank of America here. We're going to start with the weekly chart, and the weekly is always a great way to get that bigger picture perspective. So you can see 2008 into 2009, we are back approaching what looks to be our 2010, our recovery highs from 2009, 2010, back into this $14, $15 area, possibly even a little bit higher. Up here you can see this is where Bank of America had trouble technically back in 2009, 2010. This price was about $18, and there's no reason to think we can't get back into that $15, $16, $17 area. It's just a question of following the trend here. The daily chart still looks good. I'd say, a little bit more consolidation, maybe even a little bit of a healthy pullback here. Could be some good corrective action for an opportunity to leg into the long side again.
Great. So let's go ahead and move on to the tech sector. Facebook yesterday continued its comeback after a tough start to its life as a public company. The share price was halved following the IPO in the 4 months after the IPO. But recently the stock has started to really show some persistent strength for the first time since it's been public. On November 14th, I think was the day it really ignited on the biggest IPO lockup expiration that it had. It was 30% of its float was released into the public trade, and the stock ignited, and it hasn't looked back since. And yesterday we got another extension higher despite the very quiet, low volume market.
Okay, so let's take a look at Facebook. Let's look here technically at the key levels, because I really think price dictates everything here. This was the IPO. Obviously, you can see in Facebook. We've all told the story many times, and everybody knows at this point what was. You have to respect resistance, right? This is significant price resistance here in Facebook. That comes in around 32 to 33. I'm going to call this zone, okay, up here, significant resistance. This is the area where, Facebook attempted its first bounce and failed miserably. So there's a lot of supply or resistance up in this area. So let's take a look at the daily. Now, as good as Facebook looks, you can see we've seen, it got a very controlled pullback. And, like the market early into the new year, we're seeing, another breakout here. But I would be very, very careful on this breakout, only because just above us, we're going to get into that zone. Like I said, this is that, resistance zone, and it can go anywhere from 30 to, 33.5. So if you are looking to buy Facebook, make sure you understand the risks that you are taking as it gets closer to that resistance zone. It's not as, to me, it's not as good of a long as it could be. If it can trade into resistance, build a nice base up here for a few weeks, even a month or two, I think it could be a better long. I wouldn't go chasing price. Again, if you're a short-term trader looking for a move from 28 to 30, that trade can definitely still be there. But manage your expectations up in these levels.
Okay, now we're going to move on to Apple, and I almost feel like we shouldn't even be talking about Apple because it's such a not compelling chart, but it's such a big influence on the market, so we're going to cover it. It remains very heavy on Wednesday, the first day of 2013. It gapped up very nicely, but in the following 3 sessions, it's been very weak. It filled that gap. The macro chart remains very bearish. Laz, let's take a look at it.
Let's take a look. I'm going to disagree with your statement about not compelling. I think it's all a matter of, what story you're trying to tell. For the intraday or the short-term traders, the cash flow trades, the stock has still been a great source of opportunity for those with smaller time horizons. For those that are more the investor, larger time horizons, looking for the bigger picture, yeah, it's not quite the same. But like every stock, at some point the story ends and we go through periods of contraction where you don't get those exponential gains that I think everybody's become so used to with a stock like this. This is healthy action for the stock. Every stock, in order to go higher, needs to contract, needs to pull back, needs to base. So at some point, whether it's a week, a month, 2 months from now, we'll get back into a stage where the stock starts to expand in price again right now. Right now, like John said, we're going through a contraction stage. You can see here on the weekly, 4 or 5 weeks right here of basically sideways action. Now we're basing sort of on the lower end of the range, and all eyeballs are on 500. 500 has been the level that we've seen hold multiple times. Let's go back to the daily just to get a more granular look here. You can see that 500 area of support, tested 1, 2, 3 times at this point, but really no real substantial bounce. Yeah, we've seen a day or 2 days of pop, but we are now building a range. It is very, very clear to me that the stock is between 555 and 500. If you're going to trade a stock that's in a range, make sure you are, you understand that the way a range trades. And the way a range trades is that, you want to look to potentially be a buyer or a seller at the high or the low end of the range. If you're going to trade a stock like Apple here in the midpoint of this range, it's going to be harder money. You have to take down your time frames, look for intraday trades off of 5 and 15-minute time frames or 5 and 13-minute time frames, as we teach in the active trader class, but there still are those cash flow trades as the stock still gives you, $7 to $10 ranges every day. So again, if you're going to look to Apple as a source of opportunity, make sure you go at it the right way with the right mentality.
Okay, let's move on to Amazon, a stock that has sort of taken the mantle from Apple as the leader in the high beta tech sector. Amazon yesterday on an upgrade gapped up near new highs and then continued during the session, made a new all-time highs, rewarding investors that have stayed with it as it stayed in the upper end of its range, near highs. And Amazon's been terrific. Go ahead and take a look at the charts, Laz.
All right, let's take a look. Amazon's been just amazingly impressive. Even I am impressed with what's happened here. I certainly didn't anticipate this type of price movement. But we, listen, we have to follow the footprint of money, and the footprint of money right here says the stock wants higher. Breaking through a pretty substantial resistance level very easily, I would say, through that 263 level yesterday on an upgrade, and right when it opened, boom, we saw just buying right off the bat. Now, at this point, the stock's a little extended to the upside, coming from about 240 to 270 in a matter of 4 trading sessions. The stock needs to take a rest. It needs to consolidate. It needs to even give you a controlled pullback at some point. I'd like to see this breakout above 263, 264 hold. That'll be a key for higher prices. If we can base, build a nice flag up here in this upper 260 area, I think the stock can definitely see higher. Let's take a look at the weekly real quick just to get that bigger picture. And you can see, all signs still point to higher. There's really no stopping as we still have a rising 8 above a rising 21 and making new all-time highs. Now, I'm going to tell you, just like I said with Facebook, you don't want to be, you don't want to be chasing price. Amazon, if it's going to go higher, it's going to give you an opportunity. It's going to set up. It's going to pull back. It's going to consolidate. It'll contract in price, just like everything else, and it'll give you that lower risk entry at some point in the near future. But I do like Amazon, and you have to respect the fact that the market loves it too.
Finally, let's take a look at Google, the final piece of that trio. Google has really battled back very impressively from that earnings debacle we saw when earnings were leaked intraday and we had that big wide range down bar. Google yesterday, after a few days up, took a rest, which is very healthy and normal action. Let's go ahead and take a look at that chart, Les.
Yep, let's do it. Here's the weekly in Google, and let's go back and look at October. And October is really the key month here because October is where we saw the stock really break down in price substantially. You can see once we undercut this level here in Google, it's about 740, mid 740s in here. Once we really got through there, that's when the selling began. So let's kind of extend this out because I think Google's at an interesting area where you can make the argument it's trading back up into what is now or should be now some sort of resistance zone. And we've seen a nice controlled month over week over week retracement here in Google back into 740 resistance. I'd be very, very careful because I think the stock's going to have a tough time getting through this area. I really think that it's either going to give you a multi-week base or possibly even pull back. I would love to be a buyer of Google on a pullback. You have this open gap here that's still open. I suspect we might pull back again, and maybe in the lower 700s. I'd look to be a buyer. At this level, to me, it's high risk, hard money.
Okay, let's move over to another sector that is an exciting sector. It's had great price action of late, but it might not be necessarily the time to jump in on the trade and chase price. We're talking about the 3D printing companies, DDD and SSYS. It's a very exciting story. The 3D printers are seen as one of the great new technologies that could emerge over the next several years. Right now, the story is more exciting than the numbers. You see the PEG ratio for these stocks, for example, are around 3. It's the price to earnings ratio relative to growth, which indicates that the price is a little bit inflated based on the growth rate. But like I said, the story is very exciting, compelling, and it's starting to leak onto Main Street. And you're starting to see these stocks really run. Let's go to the charts, Les.
All right, let's take a look at 3D. And the story is great, but the story is not a new story. Maybe it's getting more headlines, excuse me, because the market's looking for that next great thing. Apple's not, Apple's been in that funk, and some of the other big cap tech stocks that have made a lot of people a lot of money are not quite the same in terms of composure as they once were. So I think the market's looking for something new. And this story, if you go back, this is a weekly, or even a monthly, just to get a bigger picture. The stock really 3D has come from $3, $4, $5 area to now at 60. So if you look at 2009 through 2000, even the end of 2012, the story's been happening for a while. It's starting to accelerate here. This is a monthly chart. You can see it's starting to break away and really kind of lift itself to that almost euphoric stage. Now I think there's still some more upside to be had here, but like I said, with earlier prices, the way to mitigate risk as a trader, even as an investor, is to look to buy pullbacks. You don't want to be chasing this story. You don't want to be chasing new highs. I think there's a lot of opportunity here, and there's been a lot of opportunity, but wait for the right setup. Wait for either a period of contraction or even a pullback. In the short term, yes, we can definitely see, some higher prices, but I would go at those trades with a shorter term, approach, working off of some smaller time frames in DDD and SSYS, the other stock you mentioned. This to me, not quite as extended here. I definitely think there's some more upside. You can see new highs even a 2-day contraction and breaking out yesterday again. So it looks like there's still some more upside here, and I would look for those with, again, smaller time frame glasses, if you will. But the charts look great. They continue to make new highs, and stay with them until something changes. And when that change occurs, you start to get that pullback. Then we'll look to reevaluate, and possibly there'll be a better opportunity there.
I think Laz's point is a good one, that just because these stocks may not be longs right now, you may not look to initiate new positions, doesn't mean they're necessarily shorts. Everything that we do needs to be calculated and needs to be prudent, as we like to say. And a lot of people might be looking to short a stock like DDD because it's extended right now, but that's not the philosophy we like to take here, and not a good idea in our opinion.
If I can just add to that, one of the things that we constantly teach in some of our education programs is, weekly charts are very, very valuable for short-term traders and for longer-term investors, because they really tell you a story about trend. And what we look for, most of us are trend traders. We're looking for stocks that are either in substantial uptrends or even substantial downtrends. And those are the ones you want to look for to buy pullbacks. So when you look at a chart like SSYS, and you have a rising 8 above a rising 21 above a 200, that's a clear-cut signal. The stock's in a very, very strong uptrend, especially when you see it on the weekly time frame. So when you see that, what you want to do is you then want to look to some of your smaller time frames like your daily charts, and you want to look to buy pullbacks. Those are outstanding opportunities. And on the flip side, when you have declining averages below a 200 on a weekly, it's telling you the stock's in a strong downtrend, and you're going to want to look to short bounces. And it's one of the easiest and simple techniques that I think sometimes it doesn't really get the attention from a technical perspective, and it's so easy to define, should I be here, and if so, is it the right time, or should I look to buy a pullback?
Great points, Laz. All right, now in the quick hits, we're going to go over a couple of indexes that we don't go over as often as we do the S&P and the NASDAQ, for example. We're going to look at the XII, which is an institutional index of the 75 stocks that comprise the majority of institutional portfolios. And it's something we like to look at as another indicator to see if there's divergences or whether it's showing us something. Laz, let's go ahead and go to the charts.
Yeah, the XII is something I tend to throw up every now and again here in the morning call or when I do a recap. And it will mirror the indexes. It'll look almost identical to the S&Ps. But what it does is it kind of gives me a sense of institutional money flow. And it measures the 75, like John said, most widely held institutional stocks. And what you can see here is that we have this interesting little pattern after this big gap up. But it's like the S&Ps, this is going to need time. It's going to need time to either continue to base or even possibly pull back. And I like to just bring it to your attention because I think it's a much cleaner looking chart. Sometimes the S&Ps tend to have a lot more whipsaw in them, and I think it's worthwhile to just to kind of throw out there and keep an eye on the XII, because it does measure institutional money flow, and institutions do move markets. Retail traders generally don't move markets, so it's nice to know what institutional money flow is doing.
Let's also take a look at the IWM and see what that's showing us.
IWM is the Russell 2000, and it's actually been the leader. New 52-week highs here in the IWM, whereas in the S&Ps, you haven't really made those 52-week highs. So the Russell here definitely leading, and some of the small caps definitely leading this charge. So I would keep an eye on some stocks in the Russell. If your attention's not there, if your eyeballs aren't there, mix up your portfolio a little bit, open up your symbol list to some things that maybe are trading, that are largely weighted in the Russell because they are leading this market.
The last thing we're going to look at in quick hits today is the credit card sector, specifically Mastercard and Visa. These stocks have been some of the strongest stocks in the market, over the last couple of years, especially last year, a great year for the credit cards. We're going to take a look at the charts here to see if we think that can continue or whether these stocks are ripe for maybe a little bit of a rest or pullback.
Well, like in other things, this is Mastercard. We'll take a look here. Mastercard has been just a monster. I mean, there's really nothing I can say here that the chart doesn't say for itself. Strong weekly chart, very strong uptrend since 2011. Still continues to make new highs, still looks good. On the daily time frame, we broke out, early in the year with the market. Got a little 2-day pullback, and yesterday, boom, new highs again. The stock in the short term, maybe a little extended up here. You could see another new high today. I would look to buy a pullback here. again, you don't want to go chasing price. Visa, the same thing. There's really not much I can say. Every pullback has been bought, and as opposed to trying to figure out, is this the top, stay with the trend. The trend is your friend. I hate to sound cliched, but the trade of buying pullbacks has worked and has continued to work. And for all intents and purposes, it's going to continue to work until at some point something changes. And if and when that does, I'm sure we'll be all over it.
Thank you, Laz. That's it for today's morning call. We appreciate you tuning in, and we'll see you in the virtual trading floor and on the daily recap.
Hi, I'm Sean Hendelman of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.